Hey guys, it's Crossroads here. Today I had the privilege and honor of interviewing Brad Freeman. Brad is perhaps best known for his presence on X. He is the stock market nerd. I'll put his information below. He has a very fantastic newsletter here at stockmarketnerd.com that's well worth checking out if you're into long-term investing. And that's what the discussion really centers on is how he got started in investing, how he got started with his newsletter as well, and some tips for long-term investing. Thank you for joining us. Brad, how did you get started in that?
Yeah, good to be here. Happy Friday, or probably not Friday when people are listening to this, but happy Friday to you anyway. But yeah, I finished undergrad. Bit of a lost soul. I knew that I really liked investing in stock picking, but I kind of dabbled. My major in undergrad was called general studies, so really just take whatever you want, and so took a lot of econ classes. Almost finished that degree, and then decided I didn't want to do econ. So basically what I'm trying to say is finished undergrad with a degree that wasn't really conducive to quick progress and quick upward mobility within finance. From there, I went to grad school. I got my master's in finance from Michigan. Then started working for a registered investment advisor and Motley Fool. So kind of a busy period in my life for, it was probably around grad school started in 2019, then pandemic hit and Motley Fool and the RIA were during the pandemic. So RIA wasn't great at giving remote work, kind of an old school shop, but had met a lot of people, learned a lot of stuff, great resources, just was more manual, paper based. So wasn't getting a lot of work from them. Motley Fool, again, loved my time there. Maybe some cultural differences with me wanting to title a bit differently and not, and maybe cater to a different crowd. So, from as I was doing all of that, was building the Twitter audience. People like Brian Feroldi were super helpful and instrumental in giving me a critical base to talk to grow from there. And slowly but surely, the newsletter started making money. For a few years, it was all ad revenue, which was pretty up and down. Felt like a baller sometimes, and felt impoverished during other times.
Sure.
But June 2024, paywall went up for subscriptions after 4 years of writing, and really just building trust and proof of concept and getting everyone comfortable with me instead of just saying, hey, give me your money and trust me. Wanted to have a really several year base of work, or body of work to show people. And yeah, from there, it's been a year now. So I guess a year and a few weeks. And yeah, that's been the full-time job for a few years. It's been a lot more comfortable of a full-time job for the last 13 months versus the few years before that. But yeah, I've always really had a passion for investing that hasn't always manifested itself in the most responsible ways. So you can imagine during undergrad years when there were no sports on to watch, I liked betting on options and thinking I was being an investor and thinking I was going to figure out how to do that and make it big that way. But it took me a few years of losing and failing, and fortunately not having very much money when I was a poor undergrad student to figure out how to repackage that passion and interest and drive into something that's actually sustainable and can responsibly build wealth and make a career and not make me a degenerate, like for lack of a better term, I was acting in my late teen years.
Yeah, there's a little degenerate in all of us. But
Yeah.
Did you go as far as like zero DTE options or?
Oh man, it was and it was like I would go on CNBC. I would turn on CNBC. Like the halftime report was I have to watch and now if you know me, I talk smack about CNBC all the time and the sensationalism and all that. But I remember it was the Nigerian brothers who would come out with unusual options activity and here's what we're betting on, and I'd be like, go bet on it, and just it was extremely unhealthy for sure. But yeah, it was. Again, fortunately, at a time when I had very little money. So
Yeah, no, it's that's one of the best times to make mistakes, and just because like you lose $100, $200, it's like it's not the end of the world, and thankfully you had a good enough head on your shoulders that you knew that. So, what like was a trigger that helped you realize like, okay, what I'm doing, it's not going to work. I need to do something different.
I think it was the failing, and I mean, it was a few $100s at that time. Felt like it had more zeros at this point in time. It felt like a lot of money. So even though in hindsight it was not financially damaging and didn't set me back, and fortunately I wasn't on Twitter talking to anyone and giving advice because that would have been counterproductive for everyone. But I think it's just trial and error. And when you have skin in the game and when you feel those losses, it really, at least for me, it drove me to figure out a way to first, it drove me to try to work harder and to try harder under the degenerate options gambling umbrella, which was never going to work. But eventually it forced me and pushed me to kind of rethink things. And hey, I really do enjoy financial statements and numbers and filings and all these things. And I want to do this for a very long time. And I want to structure it in a way that it doesn't make me feel like a crazy person all the time. So that's it's losing is the best education, I think. Much more so than being told you're going to lose by someone smarter than you, where in a few years you can look back and say, hey, you were right, my bad. But at that point in time, I think I needed to lose.
Yeah, you hear statistics like 90% of the day traders lose money, and it's like, well, I'm part of the 10%.
Yeah.
And there are some special people out there, but I'm not one of them. You found that you're not one of them. Now, going back before we talk about long-term investing, like what first got you into stocks and investing in the stock market?
My dad. So my dad's been just a really great role model for me my entire life. Didn't steer me towards the stupid things I was doing in undergrad, was very not okay with that. So that was also helpful for me figuring out how to be a mature adult a decade later. But he when I was just an infant, bought a few shares of Bank of America and McDonald's and Disney for me in a portfolio, and would walk, not when I was an infant, but when I knew how to do arithmetic, would walk me through, here's what a PE ratio means, and here's how much money you made on the stock, and here's why, and here's how profit's growing, and here's what I'm looking for them to do next. Because he's always been an individual stock picker. He's always been a retail investor who manages a large chunk of his own portfolio. So that has, and a lot of people give me crap for kind of having like a little bit of boomer in me and being maybe a little bit more boring than most 28-year-old investors are in terms of risk tolerance. But I think that came from him and came from just a deep respect for risk and risk management that he's instilled in me that I was able to embrace eventually. But yeah, it's him keeping me in the loop, keeping me interested, keeping me engaged, and making sure that it was blatantly obvious that the U.S. stock market is, when approached correctly, the greatest wealth builder the world has ever seen. Yeah,
and I agree with that absolutely. That and it's good that you have a little boomer inside of you. You're one of the youngest boomers sitting out there.
Yeah, I think I'm technically Gen Z, but I'm like, if I was born 2 weeks earlier, I would be a millennial. So I like to package myself into the millennial crowd sometimes. But yeah.
Likewise, yeah, I'm actually like on the edge, and 1980 birthday. So it's like, I'm a millennial. That's what I am.
Yeah.
So on the other side of it, though. So,
and I'm 97. So the other, the end of that, yeah, same border. So
yeah. No, that's awesome that you had a role model there that could, not only let you make your own mistakes, but say, hey, this is a mistake, and here's a way to actually compound and make gains. So when you began to shift from the pure degeneracy of trading and it just wasn't working out into long term, like what type of things initially were you looking for in terms of stocks? Was it like quality of companies, brands you knew, PE ratio? Like, what do you remember what you were into in those early days?
Yeah, I kind of, well, maybe I kind of did the opposite of what probably a lot of people do. I was very much so a value-oriented investor and a bargain hunter. I think Boeing was like my largest position in 5 years ago. So to give you an idea, Boeing that's not the type of company I really invest in or approach anymore. And I think it started off with a very basic understanding of financial statements with just revenue, gross profit, operating income, net income, and just understanding those concepts and what they mean, but not understanding the intricate, weird, sometimes counterintuitive rules of GAAP accounting and how that can frequently throw off a metric from quarter to quarter. So it's like step one is understanding how to read an income statement. Step two is and I guess step 2 and 3 and 4 are taking several years to understand, well, that doesn't look right, what it should look like. So there's probably some one-off event, a mark-to-market equity gain, a change in tax rate, a tax reserve release, some kind of restructuring charge, something in the financials that are making it look different, where you'll see, like I think Uber's a good example here, where headline numbers can be Uber EPS falls 50% year over year. And then you go and look at operating income, GAAP operating income and adjusted EBITDA. It's like that rose 20% year over year. So what just happened? And you look into their equity portfolio, and you see that they have a lot of public holdings that have volatile value changes from quarter to quarter, and you mark those to market every single quarter. So if those get cut in half, that's a massive drag on net income, and the headline number is going to look terrible. But if you look under the hood, it's going to look really, really good. So it's getting from a surface level understanding of financial statements to really mastering, not mastering. I'll never have mastered anything about this. I'll always be learning. But it's understanding when something looks wrong, what you then need to go look for to understand why that's not looking like what it's supposed to, or if it's actually just weird.
And sometimes they have weird quarters anyway, companies do.
Yeah.
So.
But I think to answer your question, it's always been fundamental analysis driven. It's just gotten slowly better and more intricate, I think, over the years.
Yeah. And that's one of the things I really like about your newsletter is that a lot of times the way that even long-term investors look at the market is it just look at this quarter, this earnings, and then just move on. You forget about it. And you put things in context very, very well. Not more than just year over year too. You show trends of where it might be going, what's happening, like a very detailed breakdown. And I enjoy usually even companies that I follow in great detail. There are things that you pick out that I'm like, oh, I didn't notice that, or I didn't think about it that way. So
Thank you. Really good. And I mean, selfishly, I cover about 50 companies, maybe a few less than that in the newsletter. So, and I only own 20 of them. So, and the other 30, some of them are dictated by everyone in the world wants to know about this company, but most of them are dictated by, I'm kind of considering this and it's close and it might be an interesting part of the portfolio at some point. So it just really gives me an ability to react to real-time news and price fluctuations, because I think understanding when to take advantage of that and when not to take advantage of that, and also understanding that our decision there is going to be wrong sometimes, but maximizing the likelihood of it being correct is based on having just a really firm, intricate, and I know you know this, but a firm, intricate knowledge of fundamental health. And so if a stock falls 50%, but the company's killing it and earnings are continuing to grow and revenue is accelerating, that's an opportunity. But if that's not happening, then maybe it's not an opportunity. And by following these quarters, every single season, it kind of tees me up to know, like there's 7 or 8 companies on my mind right now that I'm just waiting for to stub their toe, or for some dumb analyst, for some smart sell-sider with a dissenting opinion to call out some trend or look too closely into some third-party data point to open the door for an entry point. And those entry points I only know to take advantage of quickly if I'm doing all this work quarter after quarter. So
yeah, they're only dumb analysts if it's against a stock that we have heavy holdings on that we don't want more of. So.
And as soon as they upgrade, then they magically become smart again.
So brilliant, yes. Selection bias right there for sure.
Exactly.
So you have, So how do you do like 50 companies? Because I know that you do this, for a living and everything. And I'm more on the hobby side. I've got a full-time job, my dream job and everything. But, I can track, really, really closely about 5 names. And I have 5 more, that I track, close, but not as close. And then another maybe 10 that are just, I look at headlines. I maybe look, briefly at earnings, like 50, and you go into like detail on these. How?
Yeah. So believe it or not, I'm not using AI or any chatbots or like this is, I definitely, when there are companies like like new, what's new? Like if I was looking into Rocket Labs, which is not on the coverage network, completely new sector to me, I would use Gemini to say, hey, here's my understanding of the company. Is there anything in here that looks inaccurate to you? Or is there anything that I need to fix? So I do use AI to make sure I'm not saying something stupid, but in terms of following all these companies, I think the very first earnings review that I write on a company takes a very long time, just because I'll read a transcript with 12 products that I don't know that I need to look up and figure out what they do and how they fit together and what go-to-market looks like and all of those things. But it's almost like it's not a great analogy, but income statement, balance sheet. I'm creating the stock for the stock of information for the company on the very first earnings review. And then as there are more earnings reviews, not everything is changing. There are just a few parts of the business that are updated. There may be a few new launches, So things are a lot easier to write second, third, fourth reviews, just because I don't need to look up every definition the second, third, and fourth time. I know what that means. I know what that means. I know what they said that they were supposed to do. And here's what they did. Was it better or worse kind of thing? So it gets a lot faster. And so for readers, the 101 sections at the beginning of every earnings review, those don't change very much quarter to quarter. So if they change the name of a product, if they had a new platform launch, if they bought a company and now they're integrating a product suite, then it'll change. But that 101 section, I'll read it just to make sure that maybe there's a word I can take out to make it read more cleanly. But that's not changing very much quarter to quarter. The only I get, well, it is time consuming to read the transcripts and to summarize those and all that, and putting together financial documents are too, or financial charts are too. But it gets repetitive. The work gets super repetitive, and I think that's important to understand for new investors. A 10K and a 10Q are extremely intimidating documents opening for the very first time. And then you read 10 of them and you think to yourself, do I really need to read for the 10th time that there's a risk that if the company doesn't execute, the stock might go down? Like, do I really need to read that risk section for the next 2 pages? And just there's a ton of repetition in these disclosures. There's a ton of repetition that just allows us not to skip anything, but to read things a lot more quickly from time to time, just to make sure that there's not anything new that was added. But it's gotten habitual. It's gotten to a point where it's almost muscle memory, like riding a bike. I know the process. There's this step, and just cranking them out one at a time. And while it is intricate, while it is time consuming and cumbersome, and while I am working 80-hour weeks during peak earnings season, again, I just think that is why I can see a company fall out of favor and know exactly when I want to take advantage or not take advantage. It is a labor of love, but fortunately it's a passion, and it's only 80-hour weeks, maybe 2-3 weeks a quarter. And then the other weeks are more normal that you'd expect for hours.
Yeah. No, I've used your homework, when I'm looking at companies that I'm just getting there. Like, you're my Gemini, basically. So I'm looking and I'm like, okay, I'm looking into Snowflake. This is like 1.5 years ago. And I'm like, okay, it's interesting. And then I'll bring up I'll do my research first just so it doesn't skew me. And then I'll look at what you're saying. I'm like, okay, yeah, there's a bunch that I'm missing. So just very good. And you do a great job. And you do an awesome job of, like, okay, you got the metrics here, which are very important. But then with every single company, there are some like very key things to know, to look at as far as trends, narratives, things that they're working on developing. And you isolate those, I'm sure pretty quickly. And there might be one, like when you're initially covering a company that you're like, yeah, it's not that important, then it becomes important. But you do a great job of like kind of showcasing, like, here's what I'm looking at. And it makes my job a lot easier when I'm like, okay, I don't have the time to devote to digging and spending like 10 hours after earnings going through everything. I'm like, okay, I got Brad as a cheat sheet. So I appreciate what you do.
I appreciate your appreciation. It's a win-win. So
how many subscribers are you at now? If you don't
I try to keep that pretty private. Free subscribers, like 38,000, something like that.
Yeah,
but since the paywall went up, really very little free subscriber growth. Because you understand, a lot of people will get annoyed at paywalls and screw this and unsubscribe. So free subscriber count's been flat for about a year now, but fortunately paid has been not flat.
Yeah, no, that's awesome. So you're a long-term investor. What stock in your portfolio have you owned the longest?
Meta,
okay.
Yeah.
So was that before it began tanking to $90 that you had some, or did you buy?
Yeah, definitely before, and a lot more fortunate. I think that part of my investing success, so and timing is everything, and luck is something. And I think the time in which I gained disposable income and had money to actually invest in stocks was really towards the very end of 2022. So the time the floodgates opened to start accumulating was probably one of the best times over the last few decades to be accumulating. So whoever I have to thank for that, I would like to thank. But definitely owned Meta before that. Owned Meta all the way down. I've owned a lot more Meta since then. Probably will own it for a very long time. I just think having it's not even just the network effect in terms of ad targeting and economies of scale from having half the planet on your apps. But then having open source models that, and there is a narrative that they're falling behind a little bit, but I think that's overblown, and these companies are going to leapfrog each other over and over and over again over the next few years. But having half the planet on your apps and the distribution, the data that comes with that, and then open sourcing your models and having developers attracted to having half the planet on your apps and wanting to build for that audience because that's how they get paid. I just think the amount of data and attention and work and focus that's being put on Llama right now, and not just Llama, but Orion and now the Oakley glasses that they're doing with with their Ray-Ban partnership. I think just hard to envision them not being more relevant or as relevant as they are right now in 5 or 10 years. Not to mention the fact that Apple really fired their bullet at Meta a few years ago with the restrictions of cross-app data sharing, and that really threw a massive wrench in Meta's business. And then you had this gigantic viral competitor come online in TikTok, and those two competitive threats really manifested. And Apple probably, maybe you could argue, did this intentionally because there's been a rivalry between them for a while now. That all came at the exact same time, and the fact that they overcame both of those headwinds, and we're back to delivering strong revenue growth, having Reels dominate content consumption on their apps, and having that lead to large upticks in engagement in a little over a year. I think that battle testing is more intense and more aggressive than most companies are ever going to have to deal with in their lifetime. And the grace and seamlessness in which they overcame all of it was just, there's been a lot of evidence of Zuck being really good at his job, but I think that was just, two of the most TikTok and Apple coming for your business at the exact same time, and you figuring out how to spend the right dollars in the right places in your core AI business to fix app targeting in a little over a year and to fix engagement in a little over a year. He's very good at his job. So I think that's a cool take at this point. But
he's a great CEO, and it's a very good company, and you're up a lot from that bottom. So that's, like every shareholder in Meta basically is up. So except for maybe the last few that have gotten in, maybe the last day or two. But so with Meta, like one of those parts which was a part of the narrative at the time is just like Zuck spending like crazy on the metaverse, and so that was a big part also that tanked the narrative. And it's one of those things that for guys like you that have a long-term mindset that are following the stock, you look at that and you're like, that can change. That's not something that it's like they're just burning $20 billion and they'll see no fruit, and they can't say, okay, let's just slow this a little bit. And it seemed like that the narrative began to shift immediately when Zuck just said, okay, we're gonna back off just a little bit from it, not completely, we're not ditching this, and here we are.
I think it was pivoting the CapEx dollars from the metaverse to mainly core AI, and core AI is just a fancy way of saying figuring out a way to use our data more creatively and more effectively, to make sure Apple preventing us from using data from over here and over there isn't preventing us from delivering strong return on ad spend for our advertisers, and great automation and great reporting and all those things that make ad demand flock to your platform. But yeah.
And I believe you cover all the Mag 7. Is there one? So probably Meta's your favorite out of those, as far as
it's hard to rank. There's a few in there that I'm really big fan of. Were you about to ask which is my least favorite?
Yes. Yeah. I've got two guesses. It's either Apple or Tesla.
Those are the two that I'm currently picking between in my mind right now. I'll go with Apple, just because I think while I'm skeptical about I'm not skeptical about Tesla being a very large part of the AV market in the future and being successful there. I'm highly skeptical about the pace in which that rolls out and how seamless that is, and how they're going to have 1 million robo-taxis on the road by the end of the year. I will take the other end of that bet, but I would never really bet against Elon, just because, despite the fact that his timelines are usually not accurate, what he says is going to happen eventually does. And I wouldn't want to get out and say that is not going to happen anymore. He's so, some people are going to think that I'm criticizing him when I say this, but I'm not. He is such a phenomenal storyteller for his company, and such a phenomenal figure and face to drive that narrative. And that has netted Tesla a massive premium for a very, very long time. And even when you're seeing things about Austin maybe having a few issues and being geofenced and being a very limited launch, still being able to create the kind of excitement and drive and passion within his investor base to continue that narrative. And for better or worse, I mean, he's phenomenal at it. And I don't really think anyone else that I can think of comes close. Maybe like Mark Benioff or something, but all he does is say the word incredible 50 times in an earnings transcript. So, but I'll say Apple. I really think that Tim Cook is a phenomenal, or under Tim Cook's leadership, he's been a phenomenal financial engineer. Luca too. Well, he was there for a very long time, and he deserves a lot of that credit as well. But I mean, you watch these WWDC events, and there's not much interesting from those launches, and there's not much newness, and the newness that is coming out from Vision Pro is just as unattractive as Meta's Quest device right now, and both are so many iterations and so many years away from that being an intriguing product for more than the extremely passionate Apple or hardware or tech people. So I think that's not going to matter for a while. They have enough cash on their balance sheet where they can just manufacture profit growth for several more years. And that is a byproduct of how incredibly successful the company has been for so long. But at some point, you look up and you see, I mean, I know that I'm a fan of Meta, but I don't think seeing what they're doing in smart glasses and saying they're ahead of Apple and wearables right now is all that controversial of a take. Orion and Ray-Ban and Oakley and Prada, all four of those, with the three that are actually, or the one, Oakley hasn't, I guess maybe Oakley just got released, but with the Ray-Ban glasses flying off the shelves and then having to reorder several more times before they've even tied a lot of the bells and whistles from Quest into that device. So it just seems like Apple tried to disrupt Meta's business, and Meta kind of used that as the cue to never rely on anyone ever again and to try to control the next hardware form factor and maybe supplant Apple's business. Supplant's probably a really strong word, but when you have this really compelling hardware coming online and getting better and better over the next 5-10 years, I think there is a very clear path in which that replaces some of the smartphone use cases that we currently are leaning on every single day. But I mean, that is a snapshot of time right now. So Apple could buy a company, they could hire a few more engineers, they could figure out a new product launch to re-excite the base. There's a lot of things that you can do with that much cash on your balance sheet. There's so much flexibility that they have, so much optionality that they have if they use it correctly. I just don't think they're using it correctly right now. Which again, when you have that blue text bubble cult, which I am a passionate member of, and I live on Apple devices. You can see the Apple Watch on my wrist. I'm talking to you on a MacBook Pro with my iPhone sitting here, and all my next devices are going to be Apple. I just don't know that if you look up a decade or two from now, which that's the timeline that I'm speaking in right now, not a year or two. I think there's a very easy way to see the other companies in the Mag 7 being a lot bigger than they are today, and there's a very clear way to see, well, maybe Apple continued to not deliver growth beyond buybacks, and top line revenue is stagnated, and now they're trading at 15 times earnings instead of 35 times earnings. So, Apple dying is not the base case at all, but Apple maybe having peaked in terms of influence and control and stranglehold over consumer technology, I think that is getting a tad more likely. I just don't think it's going to be obvious or apparent for a few years.
Yeah. I look at Apple now as basically the Ottoman Empire, where it peaked and it took centuries for it to die. But people knew that it peaked, that it was in decline for a long time. And rather than centuries, probably decades for Apple, just because they do have a sticky moat. They have good products. They've done a lot, back in the past. They can manufacture growth, but you got to innovate. And in this time when the world is rapidly changing with a lot of new technologies, including AI, if you're just like, we'll just pass on this, it's like, that's a mistake.
Yeah.
And if you keep doing that, the world passes you by. And so like since you're a user of Apple, like what keeps you in that ecosystem as a user? Is it the quality of the products? Is it that your whole life is on there, or
it's so superficial? I like having a blue text bubble that says delivered with read receipts on my text chain. And I know how a group chat feels when you add the 11th member to it and they're not an iPhone, and now all of our text bubbles are green, and it doesn't feel right. So it is that ecosystem that ties together so neatly. The fact that I'd have this with other devices too, but just iMessage sitting on my laptop, and everything works extremely well together, except for my Beats headphones, which Apple owns, but I still can't get to connect to an Apple device. But it is the ecosystem, and I think blue text bubble is the symbol of that ecosystem just being such a dominant moat right now.
Yeah, I know when Google had basically announced that there is a way to get the blue text bubble on their end as well, and it's really nice. I'll admit it. It's a great thing. Doesn't always consistently work for me, but yeah, I see. A big part of the reason why people are on Apple for the most part. There's exceptions too. Is that their whole life is on there, and there's a big switching cost outside of money of like, okay, how do I move all these photos, all my apps, all my life basically
Apple
over.
Music, yeah.
Oh man,
Well,
yeah,
there's integrations, but yeah.
yeah. And AI, I think, will make it easier for people to move over, which is not a good thing for Apple. So Google is, they've got a relationship kind of with Apple. They're also a competitor too, and it's one that I don't really understand. Like, there seems like there's a disconnect in the market. I don't have a Google position. I do think it's going to outperform Apple over the next 5-10 years, probably significantly. What are your thoughts on Google, and if you're bullish, why do you think that the market? What do you think the market's missing, or is the market missing something on Google?
I think there's a very key idea in Gen AI models and agentic AI models and them being better than the other 10 on the market, and that's the data inputs that train those models and eventually drive inference and reasoning. And no, I mean, Google has 6 products with distribution to 2 billion people. They have a ton of web browser data. They have a ton of search data. They have a ton of video data through Google Cloud. They have a ton of cloud workload data. So the multimodality of the context and information in which they can feed their Gemini models is better than anyone else. Maybe you could argue Meta rivals them a little bit in that regard, but OpenAI certainly doesn't rival them there, and Anthropic certainly, which Google is a large investor in, doesn't rival them in that regard, and that's why Gemini 2.5 and that family of models has led the pack for several months now, following numerous launches from competitors and not putting a dent in at least betting markets. By the end of 2025, Polymarket has them rising up and to the right in terms of likelihood of leading the model pack. So that's not just, are you going to lead in 2 weeks? That's, are you going to lead in 6 months? And I really think that speaks to the durable lead Google is driving with these models. Not to mention the fact that their full stack AI approach, where they own a lot of the cloud, they own the cloud infrastructure, they own a lot of the chips that are going into these cloud workloads that are building these models and ingesting all this data and processing all of it, which according to leadership, allows them to be a low cost provider in terms of model training. Which, I mean, you ask Oracle, are they the low cost provider? They'll say yes, but the bottom line is they're extremely efficient with training these models, just because they have purpose built these TPUs, tensor processing units, to be able to use this data and use all of this context in a more efficient and productive manner than other people can. And then you pair with all of that the fact that they have a world-class research team in Google DeepMind, just really pushing the puck forward on model innovation. And I think that entire recipe is why I think that their tech will be very good for a very long time and industry leading, just because the assets they have that go into the tech being good are better than other people have. But that also needs to translate into Gemini growing quickly and Lens growing quickly and AI Overview growing quickly. And that's all happening. So I think at their I/O event was 2 weeks ago, 3 weeks ago, something like that, 400 million Gemini MAUs. We've seen data. I'm sure a lot of people who are listening to this have seen the Sensor Tower data talking about Gemini month-over-month MAU ads approaching 13 million and taking significant share from ChatGPT and everyone else. So it is starting to look like that differentiation in terms of query output quality is starting to matter a little bit more, and Gemini's distribution and ubiquity and ability to tie into the rest of all of their Google products is starting to matter a lot more. And then again, pairing that with 400 million monthly active users at Gemini, the fact that AI overviews, which they say that they have billions of MAUs, but that's easy to do when you're putting that at the top of a Google result page. But what is real and what is important is that in North America and India, which are two extremely important markets for them, that's creating 10% engagement lifts, and so more querying, which means more ad placements, and these AI overviews are converting at far higher rates, which means pricing power is significantly higher, which is offsetting the fact that there are fewer clicks down the legacy search page, which is why AI overviews are already monetizing at the same rate as those search results as you scroll down the page. Another fun fact: Lens is growing 60% year over year, which is the picture search product. So just a lot of things going right for Google. YouTube continuing to take market share for streaming, and it's now the largest TV provider, including Netflix. And then you have Google Cloud growing at a 30% clip. You've got Waymo scaling rapidly. I mean, there's just so many things going right for this business right now. And then you look up, it's like, 19 times earnings, and that's 6 turns cheaper than the second cheapest Mag 7 name right now. So yeah, what's really going on? Is it sentiment driven? Is it narrative driven? And when you look at financials and consider all the things I just said, it seems very much so to be sentiment driven. And I haven't even gotten to the fact that Wiz Cloud acquisition would be extremely compelling in terms of cross-selling security tools for a large, growing, and loyal base of cloud customers. Another layer of differentiation. I hope that the FTC allows that to happen, but we'll see. But yeah, I think the reality versus the narrative for Google is pretty good. They're executing extremely well. Search is growing at a very steady 10% clip, with that expected to continue. All the third-party data points of Gemini taking momentum and market share away from everyone else. So yeah, I think when those things are happening, just like for a PayPal, I'm very happy to be patient with the stock if the company's doing all the right things.
Yeah. That's the wild thing for me with Google is that literally everything except for search. Search revenue is growing. Search itself, there are aspects of search that are deteriorating or declining that are not quite in decline. They are monetizing it though. That's the question mark. And I think there's some regulatory maybe overhang too. Seems like that there always is with Google, but I think a lot of that, the market tends to overreact to whether it's good news or bad news. And that's what's happening with Google. And I'm hopeful, because I'm not in Google, but I see, okay, they have a lot going for them, even like moonshots like Quantum. Like if you want to bet on Quantum, like you can go through Google too. And if it doesn't work out for Google, it's like, it's okay. The company,
it's all good.
It's actually good for them. It's like, okay, we're not moving on to something completely different. But it is interesting just the way that the model of the internet that Google really was centered around is shifting. And so I think that there's a lot of uncertainty whether or not Google will continue to be able to monetize upon that. And if they can, like, they're probably not going to own 90% market share. And so I think there's a chance, and I'm not trying to time anything. Like if I wanted to entry in Google long-term, I'd have it now. But I'd like a little bit cheaper premium if I'm going to go into. So if search begins to decline, not just decelerate, then I think that the market will ridiculously overreact at that point, maybe even more so than it's at. So we've seen that in the past. It's stupid just because Google is like doing so much right. But that's an opportunity like you had with Meta. That's an opportunity that you had with many other names too. And so companies, what's a company that's on your list that you're following that you're like, oh man, I'd love to get into that company. Just the timing or the price hasn't been right yet.
I mean, Palantir is a good example there. I think I've thought that company was expensive since 100% ago, and here we are. And I mean, I understand why it has such an incredible cult following. They've been better than anyone else in terms of monetizing software in this Gen AI boom. I mean, the artificial intelligence platform AIP has been a home run and a half, like 10 home runs. I like a lot of home runs all tied together, but just phenomenal launch, phenomenal execution. Phenomenal upside consistently every single quarter versus consensus on the top and bottom line. And that's easy to do for companies for a quarter or two. But once you train analysts to expect, NVIDIA is dealing with this right now. Once you train analysts to expect, hey, your forecasts are probably ridiculously too low and you're going to look like an idiot every 3 months, they're magically going to start to assume more aggressive forecasts and more aggressive targets. And to Palantir's credit, that has not mattered in terms of eroding the level and pace of beats that they're delivering. But I think it's important to say and just to mention that what is the sales multiple right now? I don't even know. Is it triple digit?
It's ridiculous right now.
Yeah, I'll pull it up quickly, but whatever it is, or you can pull it up quickly if you want, but whatever it is, when you're paying this price for a company, the last 100 and however many years of history we have, and it's 82 times sales, so very, very cheap. No, I'm kidding, but whatever, every case study we have of something even getting beyond 50 times sales, you either have to make those forecasts look so unbelievably inaccurate and wrong and continue to do that for Palantir for a very long time to make more sense that maybe the forward estimates we're using to bake into this multiple were inaccurate. So that's why it looks so expensive. or there's going to be there's going to be a lot of multiple contraction. And that doesn't mean the company has to get cut in half. It could mean the company chops around at these levels for a few years and just kind of grows into its shoes. But there is a point in time where the multiple expansion for this name will begin to slow, just unless it just continues to defy gravity and beats every rule and norm and understanding of market value that we've had since 1900. So Palantir is one that I am such a deep admirer of the company. I think that Alex Karp is such a fantastic CEO. I think the culture they've built is so compelling and should be studied by so many other companies to borrow and emulate and learn from. But in terms of shelling out money at these levels, and I would have said the same thing. What's the stock price right now? 138. I would have said the same thing at $90 a share. It's just not something that I can do. All I can do is, as a long only investor who doesn't short companies, is root for bulls on the sidelines and continue saying, wow, you guys have been right, and enjoy counting your piles of money while I sit here in the corner and cry. No, I'm just kidding. But Palantir's one. ServiceNow is another. I think they've also been extremely good at monetizing the software layer of Gen AI. Consistent 20% grower. I think the cash flow multiple is right around 50x. Would love to see that. Like you and Google, I'd love to see that fall a few turns. But I think Bill McDermott's a phenomenal CEO. I think it's a phenomenal company. I think they are probably, and it's, I mean, enterprise software giants, it kind of is cliche sometimes that the apps and the software they're selling are maybe not the highest quality. Like you see Microsoft Copilot get a lot of shit. You see the products that Salesforce rolls out get made fun of all the time. But I think there's a reputation that ServiceNow either buys or organically develops quality products and ties them into a quality workflow product suite. And has been doing that for a very long time, and probably is going to continue doing that for a very long time. So that's one where I look up and think to myself, man, what was I doing in April? Where I guess I was adding to existing holdings. But if that happened again, that's probably one that would be very high on the buy list for me.
Yeah, that's the tough thing, is a lot of times when it's a quality name that you want to be in and it falls, the entire market has fallen too. So if it's like, okay, if it's just ServiceNow, or for me, like Google is one of those where I'm like, okay, if it was just Google that was falling, I would be in Google now, but it's not. It's the entire market. So it's like, oh man, Robinhood in the 20s. Yes, I'll take more of that. SoFi single digits. I'll take more of that. And just instead of going to something new, I'll just concentrate on what I love and I hold.
It'd be cool if risk assets were slightly less correlated. so we had some asynchronous opportunities to build out positions when things got more compelling, because that happens every single correction. So, man, Spotify, it's starting to finally look a little bit more Axon, like these amazing companies that you look at are trading at 100 times earnings. It's like, but like you said, everything, I mean, nothing is immune to market corrections. I mean, almost nothing is immune to market corrections. So
for Palantir, no, just kidding.
yeah. Honestly, Palantir, it's funny. The most expensive names have fared the best during April, like Palantir and Cloudflare, which routinely top all the valuation comp charts that I do. Hung in there extremely well, much better than you'd think they would. And I think that just speaks to the fact that they have an extremely loyal and strong investor following, but also the fact that people just sniff out, man, this opportunity you guys are existing in is gigantic, and you can grow 20%, not for 5 or 10 years, but for 20 or 30. You can compound at the rate you need to compound at for a few decades to eventually be a mega cap. It's just, at this point in time, are you willing to pay, what is it, 300 billion now on the market cap? And for me, it's a no, but I understand why people say yes. Hopefully you guys keep looking right and I keep looking wrong, and you can keep laughing at me.
Yeah, but to be fair, like even us bulls, a lot of us have taken gains on the way. No one gets hurt taking some gains, especially long-term capital gains. At one point in 2022, Palantir was 90% of my holdings. I just single digits, and I'm like,
man, you've had a good few years.
Yes. But I've not gotten everything right. I do sell options, and so I have had some Palantir covered calls, which I'm like, I'm just regarding those as good as gone. I keep trying to roll them, but I'm like, no, it's a good problem to have, and it's been a fun ride. But I'm a lot more diversified now, so especially here at the valuation, like it's, in my mind, one of the best companies and strongest companies out there, one of the greatest moats, one of the greatest AI stories in this AI age. But it's really expensive, and it's just like, okay, I'm a long-term investor, but I'm like, realistically, like what you said makes a lot of sense. Is a lot of these companies that are really strong, do really well, they fly really high, and then they just have to plateau for a while. And I don't know when that is, but It's up 83% this year. If you had told me that in January, I'd be like, you're lying.
Yeah,
That's not going to happen. And if you say, well, it's going to go up another 100% next year, I'd say I'd probably bet against that. I don't bet against companies. I don't short, but I don't, it's not going to do this every single year. We've been spoiled. So one company that has not spoiled us, so we own in common, elephant in the room, PayPal.
Yeah.
So what are your thoughts on PayPal?
My thoughts on PayPal, I think they're very similar to Google. I think, the big three pieces of the business that needed love and work from Alex Chris, who I'm talking to his doppelganger right now, and he's wearing a PayPal shirt, so it's very confusing for me. But you guys do look very similar. It's funny, but it's Venmo monetization, and we've seen so many anecdotes about Pay with Venmo growth accelerating, about debit card usage accelerating. These new college co-branded cards that they're rolling out. I think if you think about what Venmo's demographic is, it's that. That's when they get people in their ecosystem. So not having that before now, I know it looks simple and it's aesthetic and it's surface level, but I do think it's actually important. But I mean, he's given Chris has given the stat. Really quick anecdote on all the earnings transcripts, it always says James Chris instead of Alex Chris.
Yeah.
So I reached out to him, and I feel like an idiot for this, but I said, you should tell all these people that your name is Alex. He's like, my legal name's actually James. I'm like, oh my God, I'm such an idiot. But so where I was Venmo monetization ramping extremely nicely, and then Braintree, which has been a phenomenal revenue growth driver, but a large drag on and as listeners, as I'm saying all this, he knows everything that I'm saying. So
there's things that I overlook, even on PayPal, that you pull out. I'm like, oh yeah, I didn't notice that. I didn't recognize that during earnings. So that's one of the, even if you feel like you know the company better than anybody in the world, which I do not, it always helps to get out of your echo chamber, see what other people are saying too. And sometimes it's a confirmation, and sometimes it's you see things you hadn't seen before, and sometimes people will pick out things. And I love this. It's so important to listen to some credible bears, because the bears have been right. When I went into PayPal, and I want you to continue that narrative real quick, but I went in before Alex joined as CEO, and I'm like, yeah, this is a good turnaround play. It's oversold. This is just going to be a trade for me, though. Depending on who the CEO is, I'll go long if I like it. And so Alex came in. I'm like, great fit. I'm gonna go long at this point. And I didn't think the turnaround would be this significant. I don't know that Alex thought that the turnaround would take this long either. There was more damage to PayPal than I had anticipated when I entered. So the Bears were right there. And if I had listened a little more to them, that might have saved me a little bit of money on the front end. But yeah.
No, absolutely. I mean, it's been one of my worst performing positions in the portfolio, by maybe the worst at this point. But so Braintree, they really had to. I mean, they were rationally undercutting Adyen and Stripe and all these other processors, and just stealing market share and trying to figure out how to cross sell other value added software services, but really not going to market with them in a cohesive manner to actually make that happen. So under the new team, large pivot. They've talked about a lot of difficult conversations with merchants, but no merchants fully churning. They've had some volume loss with several of the large ones. They consistently said conversations are going even better than we've expected. They've started more frequently talking about software cross-selling wins, like the FX as a service with Meta that they've talked about. Xbox was another pretty notable win over the last few quarters. But it's really been rationally pricing and taking advantage of the fact that they do have best-in-class authorization rates. Leadership says it every single quarter. They do have best-in-class uptime, and that is a byproduct of the fact that they have so many consumers in their ecosystem and such rich and detailed financial data profiles on all these consumers that they do know people better than almost everyone else on the planet, and they do know when to approve a transaction or when not to approve a transaction, which is why they have these authorization rate leads. But and that kind of brings me to and so Braintree is fully on track to, it's already contributing to profit dollars right now, fully on track to reaccelerate growth by the end of this year. That if you're looking at revenue growth right now for PayPal, I think it was like 1.5% year over year last quarter. There is I think around a 5-point drag from Braintree contract renegotiations. So that's been a large drag on revenue growth that's going away in a couple quarters. But the theme, kind of the idea I tied into that is really important for branded checkout, which is using data and taking advantage of the fact that you are bigger than everyone else and you have existed for longer than everyone else and you are offered by more merchants than everyone else. And so if you're able to use that correctly, you should understand and this is what they call agentic commerce. And to me, agentic commerce is really just getting better at personalizing experiences, making sure that when someone enters a website, they are seeing products that are tailored to them and not just a static homepage that every single person is seeing. It's knowing that when I click on this product, what payment method do I want to surface first that I'd be most likely to use and think most fondly of? What percentage discount do I need to give this specific customer to maximize my chances of converting them and creating a profitable transaction? It's using all of their data to actually understand that, to actually understand their customers and unleash that context and understanding to merchants to allow them to tap into it, to really partner with PayPal to be able to, again, customize homepages so that when I go to lululemon.com, they know that I'm going to buy the same workout shirt that I've bought 8 times for the last 15 years. And so just put that on the home screen. And then there's a lower, there are fewer pages, there are fewer clicks, there's shorter time to conversion, which all means that abandoned cart rates and conversion rates are going to be better than under the old format. So combining that with just a sorely needed overhaul and a refresh to their branded checkout workflow, especially on mobile, has been very instrumental in allowing them to stabilize that business, which is the most important business for PayPal. And then think about all those opportunities with personalization, with things like advertisements and putting direct placements on web pages where there's actionable buy buttons. That's not brand new, but PayPal does have a lot of brand clout and does make people feel a lot more comfortable when they're transacting. So seeing a product that was surfaced just for me with a buy with PayPal button and a discount is a pretty powerful value proposition for maximizing those conversion rates. Not to mention the fact that we haven't even seen Fastlane ramp yet. And I think that's going to be the most compelling guest checkout product on the market because they have this gigantic base of customers and because they have identification rates that are higher or potentially higher than everyone else has. And the fact that they're now taking advantage of that is going to mean that these people get delightful vaulted checkout experiences where they don't have to manually enter their guest data because of PayPal. PayPal is going to keep that customer relationship. PayPal is going to send them post-purchase offers. PayPal is going to try to cross-sell them debit cards. It's such a great top of funnel moment when you can turn a terrible guest checkout experience into something shockingly delightful and then say, hey, here's all the other products that we offer. The company that just delighted you wants to offer you. So I think it's those 3 things for PayPal are the 3 most important things by far. And I think you can maybe throw in Hyperwallet and some of the other value-added services that they're trying to cross-sell to enrich margin profiles right now. But they're doing everything correctly. And they're doing everything correctly slowly. And I get that. For Meta, it was as simple as we're going to cut our CapEx budget on Metaverse and start letting our extremely high quality cash printing business show you that it's extremely high quality in cash printing, because it always was. It was masked by the fact that they were spending on maybe unproductive things. And for PayPal, it was the complacency of sitting on the fact that we have a dominant checkout button and not feeling like they needed to do everything else. They didn't have an extremely healthy core business, and that core business did need to get cleaned up. And I do understand why that's taking longer. But everything that we're seeing, and we've had confirmation on the current quarter going well as of 2 weeks ago. It's good. So I'm going to keep sticking with them and keep having people tell me it's a dead company and I'm an idiot and opportunity costs and all these things. But
it has been so far. The opportunity,
I will give up on them when fundamental performance gives me a reason to give up on them, not when stock price isn't performing the way I want to, even over a stretch of now 2 years. I think patience will be worth the wait.
It has taken longer than I thought. It has been an opportunity cost, but you only know that in hindsight. And so a lot of companies that you own and I own as well were seen as opportunity costs just 2 years ago, and they've been anything but. So with PayPal, 2 other things. So one is, and you rightly said, like part of the AI and agentic commerce is that high level of personalization, which is inferred by data. But there's another part to agentic commerce, and I've heard that you don't find this as nearly as compelling, or you're not, but maybe I've heard it wrong, is that partnership with Perplexity, that basically using AI as a shopping agent and buying that way. Do you not find that as a very likely growth vector, or what are your thoughts on that?
No, I think the lowest hanging fruit for using AI to benefit the financial profile is raising conversion rates on their existing workflows and making sure those experiences are best in class. But I mean, when you're asking Perplexity, I'm trying to plan this evening, and I need an Uber, and I need a restaurant reservation, and I want these concert tickets. there's every reason to think that PayPal's partnership and saying, here are your options. Which one do you like better? Here's the cheapest, most convenient one. Here you go. And here's a PayPal checkout button right next to it that'll let you pay in 2 clicks. I think that can be extremely powerful. And I think the agentic workflows naturally are scraping from so many different parts of the web, and that favors people that have such ubiquitous integrations with merchants across the web, that PayPal is able to use these multi-step workflows to create actionable multi-purchase workflows for their own business, to make Perplexity money, to make their merchants money, to make themselves money. So I do think that's very exciting. I think it's maybe a little longer tail. And right now, and over the next quarter, 2 quarters, 3 quarters, that personalization of checkout is going to be the most noticeable uptick to branded checkout growth and the acceleration that they're forecasting to deliver through 2027. But I mean, more Perplexity partnerships. I would be 2 thumbs up for that. I mean, imagine imagine like a Shopify partnership where their shop app, where they aggregate these thousands and thousands of merchants in all of those pages and product, all the product discovery that happens there, and turning that into a conversational, I want a yellow shirt with matching brown shoes, and this is my size, and I want it to be this material. And PayPal being able to plug into that and race around Shop Pay and find the absolute best options and surface them to you via some integration with a chatbot. That sounds like the future of commerce to me, for sure. It's not searching for what I want. It's telling a chatbot what I want and having them give me the very best option. And I do think PayPal is very well positioned to provide that experience.
Great. So 2 other projects that they are working on, they're building out. I didn't hear you mention. One was stablecoin. I don't know unless you want to touch on that. We might gloss over that. But the big one is probably advertising. So I'm curious what you think. Is that something where it's like, I don't understand that space as much, and so, or I'm not sure how PayPal will do, and so you're just like, hey, pure upside, or do you find that as another credible growth vector, or where are you at with that?
So I love, and not all PayPal's ad products are structured this way, but I love that they take the financial risk out of advertising for merchants. They say, we get paid X% of your revenue that we're generating and procuring on your behalf. So it's not pay us this massive upfront fee for a lot of impressions. It's give us the opportunity to go find you revenue, and then pay us a fee that you'd be happy to anyway. Like you'd be happy to provide everyone a 6% discount on your items right now if it meant your revenue is going to double. So if PayPal is able to deliver that return on ad spend and fetch a small cut, I think that's a very powerful win-win for creating more just unified partnerships in a more cohesive and supportive and mutually beneficial go-to-market. But then pairing that with and ads again. I follow Trade Desk really closely. Advertising is all about personalization. So using all of this shopper data that they have, Trade Desk has had to piece this together with partnerships with Walmart and Target and Albertsons and Dollar General and all this. PayPal has all of that sitting in their ecosystem, ready to use right now. And they're finally using it. Like it seems it seems so intuitive and so straightforward, but they're finally using it. And thank you, Alex, Chris, for finally using it. But I do think for them, the most important piece of advertising is just going to be the same thing as personalizing branded checkout. It's raising conversion rates and raising revenue growth rates for their merchants, which they will mutually beneficially share in, but doing so in a way that makes merchants feel like, oh my God, without PayPal, my revenue base would be 20% smaller and I wouldn't be making nearly as much money. So how do I do more with them? How do I use them not as just a checkout button, but as like they're calling themselves a holistic commerce partner? And I could use air quotes there because I'm literally quoting Alex Chris.
But I hear a few quotes in your voice.
And I know you've talked a lot about who is leading this advertising division, and I'm blanking on the name, but the track record he had with Uber and building that track. But there's every reason to believe that he will succeed here, just like he did everywhere else with massive two-sided marketplaces. And it's exciting to see where this goes. I just don't think we're going to see advertising revenue turn into a multi-billion-dollar business for PayPal. I think we're going to see advertising momentum translate into accelerated branded checkout growth for PayPal. I think there's going to be that indirect financial uplift of branded checkout magically doing much better because their advertising placements are netting so much revenue. But I think they view that as a support system for their branded checkout business more so than a separate revenue driver.
Yeah. Any thoughts on stablecoin at all? PayPal or otherwise related?
I'm pretty new. I know the Genius Act was just passed, which does a lot to establish regulations and reserve requirements and all those things. For PayPal, I think, and I think we should tie in the Coinbase product launch and their payment stack and all that. But Coinbase is also partnered with PayPal stablecoin on removing fees for transactions using that. But reality is that the base network is using Circle's USDC stablecoin. So that does mean more competition for PayPal. And I think that's why we've seen Alex Chris and all these, with all of these context model protocol announcements and partnerships and stablecoin integrations with what was the latest one, Fiserv or something like
on Monday. Yep.
So the reality is this is a ferociously competitive market. They've had to overcome Shopify. They've had to overcome Affirm and Afterpay and Block and Apple and Google and literally everyone. It's a multi-trillion-dollar market, global market. So that is always inherently going to invite competition. And PayPal has had to overcome that for a very long time. And I feel as though that they're in a much better position to overcome Coinbase and Circle and stablecoins with their own product innovation and with their own utility than they had been when Apple Pay was proliferating really quickly and when they were way behind on innovation and work and checkout flows and all those things. But I mean, just like they've had to overcome all those new entrants, this will simply be another player that they have to beat and attract people away from to use them and use things like PayPal Anywhere and 8% cash back and stacking rewards to make sure PayPal is not just the most known brand, but as Chris always says, it is the most rewarding way to buy a product. And that's really how you turn a checkout button commodity into competitive differentiation. It's you use your ubiquitous merchant and enterprise integrations to be able to stack rewards across the entire ecosystem more effectively than anyone else can to make sure that I'm getting more cash back with PayPal than anyone else. And if they can do that, I think stablecoins will be very supportive for their business in terms of shedding FX fees, in terms of creating more real-time payment settlement. And I think those tailwinds will be more powerful than a potential headwind from Circle and Coinbase and JP Morgan and all these companies rolling out their own stablecoins, which I'm sure PayPal will be part of, as they already are with the Coinbase partnerships. But they're going to need to keep executing. They're going to need to keep giving people a better reason to choose them than everyone else. And it seems like for the first time in over a decade, they finally get that, and they finally understand that that's what they need to be doing.
Yeah, that's the wild thing for me is they had this tremendous lead, this tremendous opportunity, and they underachieved. And they did almost very little with it. The least possible. It's like somebody that if they're working a job and they're this kind of employee, it's like, let me do the minimum to not get fired. And it's like, okay, but you're not going to thrive. You might survive. And that's the environment that Alex Chris.
I'm sorry, that was probably a loud noise. It's Apple on steroids. It's the conversation we just had about Apple times 10. I think that's where PayPal was. Yeah.
So one more name that we have to discuss is, and I'm sure you know where I'm going with, it's Anthony Noto's company, SoFi. So what are your thoughts on SoFi?
My thoughts are the stars are kind of finally aligning for the company. I mean, you have capital markets absolutely wide open and humming, both for lending platform and the few securitization deals they've been able to do over the last few quarters, which they haven't been able to do in a few years, which I think is just so emblematic of the fact that their performance across cycle for capital market pundits has been so strong and so consistently better than what they've forecasted and told people to expect, that has engendered trust in a pristine reputation for SoFi's credit that I think will serve them very well across the next few cycles. And that's just the luxury of catering to ultra prime credit and having an average FICO of 760 plus on personal, 770 plus on student loans, and just being extremely picky and saying no to 80% of their loan applicants now has them in this position where while credit supply is always cyclical and that will never change, I think they will be more insulated from these cycles than an upstart or than another company that's catering to more adventurous, precarious credit buckets. But so that's lending. Our lending platform business has been an absolute home run. I think that's going to continue to take more and more of the volume away from their traditional lending structure, which will just mean more fee-based revenue, a more asset-light business model, less balance sheet risk, and really just being able to untether origination growth and saying yes to all these borrowers from their balance sheet growth. So, which is what everyone wants right now. We want We want asset light revenue. We want to make sure you can grow without your capital ratios deteriorating. And that's really what the lending platform business is doing for the lending segment. And then so switching to financial services, that's been the most impressive segment for the company for a few years now. What they've done with that deposit base, and I know people will compare it to Robinhood and say Robinhood has way more deposits, but you're comparing a savings account to a brokerage account, so it's really just not a relevant comparison at all. But I digress.
And no shade on Robinhood. I know you like, hey, they're doing great, but
they've killed it for a few years now. It's just the comparisons of people, or the ideas of people thinking that these two peanuts are competing with each other for market share instead of competing with Bank of America and JP Morgan is just something that I don't agree with at all. But so financial services, the contribution margin inflection for that business has gone from deeply negative to over 40% in a few years, which is phenomenal. They've been extremely slow and conservative with scaling and growing the credit card business. I mean, I have an 800 FICO, and they will not give me a credit card still. So just to give you an idea of
credit risk, Brad.
I apparently there's something. Maybe my breath stinks or something. I don't know. But but that's important. I think while I'm modestly annoyed, I'm more happy with the fact that they are going so carefully with this business, just because losses can ramp so quickly for an underwriting model that's not seasoned enough for prime time. And if you rush that out, that can blow your balance sheet up so quickly. So they haven't. So good for them. And then you think about the fact that they're entering the crypto business and going to add that, re-entering the crypto business is going to add that back to the invest product, which is 50% under monetized. So in the fact that they've done very little on product innovation there up until the last few months, and have really finally started to focus on that, just because Galileo Technisys integration, which I'll talk about in a second, and the lending platform business has gotten such a large part of the attention for them. But they are finally focused on credit card and finally focused on invest and scaling that business. So I think, I mean, if they could create a rapid growth engine with a high yield savings product, it's exciting to me what they can actually continue to deliver when they're focusing more meaningfully on growing credit card and invest, which theoretically could be bigger than together. Those could be bigger than anything else that they offer right now if you just look at other competing products across market. So financial services, every sense of the imagination, thriving. And then you get to the tech platform. So that's been the disappointing part of this business, and that's the one. So I think they had the revised lending or financial services higher in their 2026 targets, and then revised tech platform lower. I can't remember which of the other segments they revised higher, but
financial, but yeah,
I think it was financial services too. And then for 2024, it was lending is going to be like 90 to 95% of revenue from 2023, and then it ended up being closer to flat. So that's what happened. So thank you for that. So the tech platform for me, and I talk about this a lot in our SoFi group chat that we all talk all the time, but the disappointment is actually understandable to me. And I don't want to make excuses for them. I don't want to be a cheerleader for them, but several things happened right when the tech platform business started to deteriorate and decay. Macro soured. We had 5 points of rate hikes, which that naturally extends sales cycles, naturally makes every single enterprise more picky about budget and what they're willing to spend on. If cost of capital is getting more expensive, the hurdle rates that I need to clear for these investments get more difficult to clear. And that just makes everything harder to get across the finish line for deals. Add to that the fact that they purchased Technisys, which was a massive integration project and a large price tag for this company at that time. And they have dedicated so much time and effort to fully integrating that into their tech platform and making sure more of their consumer-facing business can run on that back end. That's been a massive project. Then you had a regional banking crisis, which again threw a large wrench in financial service tech spend and the appetite for that. And then you had, then you had the go-to-market pivot, where it was we are pursuing very low quality revenue growth from these companies that have a 50% chance of going out of business tomorrow, to we are going to approach Wyndham Capital and H&R Block and these large established businesses and create partnerships and co-branded debit card programs and deep payment processing deals beyond just being that facilitator with all these companies to create higher quality, more durable, more visible revenue growth. I mean, they signed a deal they've now signed their first federal deal, which is extremely exciting for that debit program. But all four of those things coincided at the same time, right when SoFi's tech platform growth fell off a cliff, right when Marqeta's growth fell off a cliff, right when Plaid's, is it Plaid or Plaid? I've never.
I feel like I'm saying it wrong no matter what, but yeah, that's
right when their CEO started talking about fintech winters. I mean, so yes, maybe it's a coincidence, but I think there is a mountain of evidence pointing to the fact that this is very explainable. And then so all four of those things have been happening. So theoretically, rates are being cut. You're probably through this go-to-market pivot. Regional banking crisis is over. So things should be looking a lot better. And fortunately, I'd be very concerned if this wasn't happening. But commentary on the tech platform over the last few investor conferences and over the last few quarters from Noto and their CFO, Chris Lapointe, has been more positive than anything that they've said since maybe 2021. Talking about some of these churn clients that have been dragging on growth, boomeranging back to them because they realized that the pennies they were trying to save have now cost them dollars because these vendors are just not capable of scaling with them and having the uptime they need and having the authorization rates they need and doing so at the margin that they want because the Galileo can charge a little bit more, but because their KPIs are better than competition, they're still delivering really compelling margin for these companies. And I guess that didn't occur to them. So they didn't name any of these firms. But so I don't really know. We can speculate who they are, but just realizing, having an epiphany that maybe it makes sense to pay a few more pennies per transaction to make sure that this business is functioning way more smoothly with way less headache than it is since we left Galileo. They've talked about 10 companies in the pipeline that they're going to start contributing to 2026 revenue growth that aren't contributing to 2025. They talked about a swelling pipeline with several late stage deals that they haven't announced yet that they are highly confident are going to close by the end of the year. So all of these things that were holding SoFi's business back kind of faded and eased at the same time. So you'd expect the tech platform to look a lot better into the back end of 2025 and into 2026. And luckily, that is the firm expectation from leadership. So just more evidence, I think, of these four simultaneously raging headwinds being the main culprit for SoFi's tech platform, just being the most disappointing segment of this business over the last few years. So excuses go away in 2026. So if things don't look a lot better at that point, then it's an issue. But at the same time, and not to ramble, but even I've said this a few times publicly, but even if external client growth for Galileo struggles more than I want it to, I will still say that Technisys and Galileo were phenomenal purchases for SoFi, just because they have created a differentiated cost structure versus everyone else in the business, where we not only have no branches just like the fintechs, we not only have a bank charter like all the legacy players, but we also own our own tech stack, and we also don't pay third-party fees to 10 different vendors to make sure that our back end runs smoothly. That means more margin. That means more opportunity to pay higher APY or offer lower interest rates on loans, or cross-sell more travel perks for SoFi Plus members. So the tech platform is why their consumer-facing business can be differentiated. So to me, the external client sales, while I want that to happen, it'd be a disappointment if it didn't, but I don't think it'd be a deal breaker, because the most important part of this business is the consumer-facing aspect of it, and I do think the tech platform is such an instrumental part of that.
Yeah, and there's just so much going right now with SoFi, especially the loan platform business. If that didn't exist, I might have taken some off the table, to be honest, but it does. It's incredible. And, we only know opportunity cost in hindsight. That's a great thing about evaluating a company over the long term. And so I'm going to do something that probably my viewers will hate. They've forbidden me from doing it on X, at least when the stock market is open. I'm going to show, a stock price. Over the last year, it's up, 166.82%. A lot of that is over the last month. It's gone up 30%. But you never know if it's going to be an opportunity cost. People were saying when it was trading single digits, and it had been an opportunity cost. They were absolutely right. But you don't know about the future, especially when it's a quality company that is building in the right way, that may have some headwinds or a mix shift or something going on. I think PayPal is another one of those. Google's probably another one of those as well. And they'll have their day in the sun in the future too. That's the great thing about the markets and that long-term horizon.
Yeah, well said. So how's that opportunity cost up 172% this year, trading everyone?
I'm okay with that. Yeah, give me that in a year.
Someone's opportunity cost on a 2-year horizon can be someone's life-changing investment on a 5-year horizon. So it's timing is everything, I guess. or time horizon is everything, I should say. Timing is not everything. Time horizon is everything.
Yeah. Well, thank you so much for joining us, Brad. Two last questions. One is, where can people find you?
Yeah. So Twitter is Stock Market Nerd. URL for the newsletter is stockmarketnerd.com. So short and or simple and sweet and short. I don't know what I'm trying to say, but you get it.
Yeah, I'll put your information below in the comments, so be sure to check out Brad. And then last is, if somebody's just brand new to the markets, just starting out, is there any advice, not financial advice, of course, but any advice as far as like where to begin? Because it is a little bit overwhelming when you're first starting out.
Yeah, I think nothing wrong with an index fund to get started. I think that's probably the best option for the vast majority of people.
Oh yeah.
I think there's universities all over the country that offer free courses on being literate in reading financial statements. I think that is extremely important if you're taking the fundamental analysis route, which even if you're a trader and using technical indicators, I think it's still really important to understand how financial statements work. But from there, I would check out, and I'm not even a partner for him. I'm not getting any money for this, but I think Brian Feroldi does a great job of his YouTube channel does a great job of working through really basic financial concepts and getting everyone ready into a point where they can look at an SEC filing and can read an earnings transcript and start to interpret quality of investment case and risks and all those other things. And I think my newsletter, one of the things that it maybe doesn't do a great job in is the 101 concepts of financial investing. I do my best to define acronyms and terms and all those things, but it is a bit bulky. And I think Brian Feroldi's and he works with there's three Brians, Brian Stoffel, and then there's a third, Withers, I think his last name is, but it's funny that they're all, her first name's all Brian, but he has great entry level courses where he'll walk you through financial statements. And I think that's super important for everyone.
Oh, absolutely. Well, thank you again for your time, Brad. It's been a pleasure talking to you. And
super fun. 80 minutes. That was great.
That's right.
Yeah.